Welcome to Beltway Talk, the podcast of the American International Automobile Dealers Association, where we examine the intersection between politics and the automobile retail industry. I'm your host, Hannah Oliver. Today's podcast is brought to you by Kerrigan Advisors, the leading sell-side advisor for high-value dealerships. At Kerrigan Advisors, we believe dealerships are too valuable to be sold any other way. Find out more at AIADA.org. We're joined on today's podcast by Erin Kerrigan, the founder and managing director of Kerrigan Advisors. Erin is a recognized industry expert on dealership buy-sells, valuation, real estate, and private equity. We're glad to have her join us for this installment of Beltway Talk to discuss the dealership market as it finds itself in the middle of the COVID-19 pandemic. So thank you for joining me on Beltway Talk today, Erin. I really appreciate you coming on the phone to talk to dealers.
Thank you, Hannah, and AIDA for having me. Our firm really appreciates being an affinity partner.
I know that Kerrigan Advisors has been an AIADA affinity partner for about 6 years. And before we get into the rest of today's discussion, like the Blue Sky Report, can you remind our listeners what it is that you do for dealerships?
Sure, of course. So Kerrigan Advisors is a leading thought partner and advisor to auto dealers in some of the most important decisions they make, from their growth plans. We have a consulting practice that works with dealers as they think about growing their business. We also have a restructuring services within that consulting practice that can help dealers as they're thinking through some of the challenges of today and negotiating with some of those difficult lenders. We're most known for our sell-side advisory practice, which is a national practice primarily focused on representing larger transactions throughout the country. We are not a volume firm. We don't have listings, but we do work on a select number of very large transactions ranging from $20 million in size to upwards of well north of $150 million. So that is our firm. We are licensed with FINRA, so we can do both asset and stock transactions, and we also work on real estate transactions as well on behalf of dealers.
Sounds like you guys definitely have your hands full, and we have a lot to talk about today because a lot has definitely changed in the industry in just the last few weeks. But first, before we get on into that, I wanted to ask you about your latest Blue Sky Report, which wrapped up 2019, I believe, and you released in March. What are some of the main takeaways that you saw in the dealership buy-sell space as 2019 ended?
Yeah, so 2019 was a really interesting year. It actually got off to sort of a slow start. To give you an example, the public spending was down 59% on acquisitions, so that pretty slow start to the year. However, as interest rates came down, with the federal funds rate coming down, and as consumer confidence gained momentum, the buy-sell activity increased tremendously, so much so that the second half of 2019 was actually what we think may be the most active on record, 130 transactions completed in the second half of the year. You really felt this palpable sense of deal momentum at NADA, for instance, which was in the early part of 2020. There was just this tremendous sense of optimism, and a lot of it came from the fact that earnings were really growing in auto retail. Last year, earnings were up 4.8% as compared to 2018, and that was the first time that in the last 4 years actually, that we have seen an uptick in industry earnings. And with growth in earnings, of course, comes increases in valuation, because higher earnings usually result in higher values. So there was 2019 was a really turnaround year for the industry in some regards. There was just tremendous sense of optimism about deal activity. Obviously, that's changed a bit here in going into the second quarter of 2020.
And can you tell me, I know you mentioned there was a lot of dealer optimism, but could you kind of get into how some franchises performed versus others in the buy-sell market at the end of 19?
Of course. So in our full year report of the Blue Sky Report, we do a pretty deep dive into each franchise. And what we found is we continue to see tremendous demand, of course, for the franchises that won't surprise anyone on the line: Toyota, Honda, Subaru in the non-luxury, and in the luxury segment, Lexus, Mercedes, BMW tend to be the highest. And actually, we did a survey last year, a dealer survey, our first annual survey, and found that dealers' view, and we had over 600 dealers respond to this survey, really matched the demand we see in the marketplace for certain franchises. So dealers reported that they expected the values of Subaru, Toyota, Porsche, Mercedes, Honda, Lexus to increase, and those were some of the most valuable franchises last year. And then they expected some of the other franchises to decrease in value, namely Infiniti, Nissan, Cadillac, Buick, GMC, and Acura, and those are franchises we see in much less demand than we see for those top import franchises. We did see a lot of deal activity, though, I will say, in the domestic sector. Domestic buy-sell market share actually reflected its same market share in terms of number of franchises in the industry. So domestics, obviously, there are many more. There are thousands more domestic franchises than there are import franchises. And in 2015, we saw that domestics buy-sell market share was very low relative to the number of franchises that existed in the industry. Now their market share is reflective of their franchise market share. So about 56% of buy-sells in 2019 were domestic, were the Ford, Chevrolet, Buick GMC, and CJDR. And about 31% of the transactions were import non-luxury, and 13% were import luxury. In 2015, by contrast, 47% of the buy-sell market was import non-luxury. So domestics have really taken share from the import non-luxury, and we think that really is a reflective of domestic franchises have been doing very well, and their valuations relative to some of the import franchises are pretty attractive. So on a return on investment standpoint, a lot of buyers were pretty excited about the values they could get in the domestic side, especially with the significant shift in consumer preference for trucks and SUVs and CUVs, and with oil prices on the decline now very much on the decline today. So, the jury's pretty much out as to what happens for 2020 in terms of buy-sell market share, whether this will be sustainable. But I expect you will continue to see a significant number of buy-sells in the domestic side, because there are so many franchises, and there are a lot of families that have owned them a very long time and maybe now looking for an exit, especially after this pandemic passes.
Okay. Let's move to the current environment in the dealership market, Erin. I know that your firm's mid-March auto retail index noted that it was trading at levels not seen since 2012. Could you tell listeners what you've observed in the weeks since that report came out?
Sure. So everyone knows we are in a very volatile stock market, and it was pretty shocking. We did do a special edition of the Kerrigan Index mid-month. We've never done that because we saw the index drop to levels we hadn't seen since 2012. And it's pretty shocking that volatility, because keep in mind that the Kerrigan Index, which is comprised of the 7 publicly traded auto retail stocks, and it is structured just like the S&P 500, starting back in 2000. So that's the start date when the index is at 100. And now what you'll see is that the index in 2019 increased 42.9% in 2019. So it was on a tear last year, and it was approaching all-time high levels In fact, many of the stocks in the index hit all-time highs in 2019. So Lithia was one of them. Asbury was another that hit all-time highs. And yet into 2020, shockingly, the index dropped to levels we hadn't seen in many, many years. Since then, it's rebounded a bit back to, it's at 416, and at the low of 2020 it was at 299. So that's certainly a nice bump. But it's hard to say, given the volatility of the stock market, where it's going to go. I will say it's important to keep in mind that what a stock represents. So a stock represents the present value of the future expected earnings of a publicly traded company. And so when the stock drops so dramatically, it's because the investors, the buyers of that stock, and remember these are traded thousands of times throughout the day, believe that the future earnings may decline, and therefore the valuation is going down. When it bounces back up, the collective thoughts of those investors are that, oh, maybe I overreacted, maybe it will bounce up. So what you're seeing in the stock market and the volatility is a reflection of the unknown as to how auto retail will rebound. There are, I think, all of us on the line have moments of thinking, oh, we're going to rebound really well, and then there are moments, I think, where we all think, oh, maybe not. Maybe we'll have challenges with this pandemic for much longer than the next months, in which case no one knows what will happen. So I think that's really what we're seeing in the valuations of the public companies. And certainly we do focus in on these valuations because they are the largest companies in our industry, and they're mark to market every business day, so we know exactly how much they're trading at, and their valuations are very interesting to us. Give you a sense, the publics were trading at a 6.6 times blue sky multiple at the end of 2019. Based on our analysis, and when it hit its lows, when they hit their lows in March, on March 20th of 2020, they were trading at a 2.4 times blue sky multiple. Now that's historical earnings, so if earnings come down, then the blue sky multiple, it's inverse, it'll go up because right now we're benchmarking against higher earnings, but nonetheless, it gives you a sense of how dramatic the decline was in the valuation.
It sounds like it's been fairly dramatic. I know you talk a lot about the publics, but how do you think the current auto retail environment is going to impact smaller family-owned dealerships?
So that's a really excellent question, and we're asked that all the time. And what we find is that our industry is so interesting because in most industries, the largest public consolidators really drive the pricing for all private businesses in their industry because they're the ones buying the companies and they're setting the valuation. So if their value drops, as these companies have, there's a concomitant drop in the private sector of that industry. Our industry is not like that, and the reason is because the publics actually represent a very small percentage of auto retail. They represented 5% of the acquisitions in 2019, so they are not the major consolidators in auto retail. Despite being the largest companies, they're not the most acquisitive. And they are a small percentage of the industry in that they're less than 10% of auto retail sales are completed by the public companies. So what that means is that most of our transactions are private to private, and most dealers, in our experience, because we have a still very fragmented industry with the lion's share of dealerships owned by families, and the average dealer owns 2 to 3 dealerships, that it means that valuations in the private sector are not as volatile as you see in the public sector. And that's great news for dealers because what we find is that Auto dealers will not sell their dealership if they don't get the valuation they want. They'll just keep their dealership, and they'll sustain through so many challenging times of the past and certainly in the future. And they'll wait for the time to sell their business. And these have been very strong family businesses that families come together and they pass down the business to the next generation, and the business model works in that regard. And so we do not expect to see the same decline in value or volatility in valuation in the private sector as we have seen in the public sector as a result of the coronavirus pandemic. Now, that being said, we do expect to see some distressed transactions and even unfortunately, some closures of dealerships as we saw in the Great Recession. So we do expect to see some of those situations occur, but we don't see that as a reflection of the value. Those are unique transactions, and they're not the representative of the industry. Those are more, as we see it, one-offs relative to the 17,000 dealerships in the industry. We don't expect to see such a significant number have distressed or close as to derive valuation.
Okay. So moving on just a little bit, I know that Asbury Automotive called off its rather large acquisition of, I believe it was 10 luxury dealerships in Dallas a few weeks back. Do you think that this is a precursor to what's ahead for dealers in the dealership market? I think you kind of touched on this a minute ago, but just for dealers who observed that, what do you think this means, if anything?
So that was obviously really an unfortunate situation, and going into that transaction, and frankly, if you read our report, we thought 2020 would be a tremendous buy-sell year, in part because of Asbury's impressive move to make that a large billion-dollar acquisition. Unfortunately, the timing, of no fault of anyone, that because of the pandemic, Asbury's stock price at one point was below $1 billion for the first time since, I think, 2013. So it would be very difficult to justify an acquisition that was larger than your own valuation. And so that was very unfortunate. I do not think, though, that this is a precursor to fewer transactions. In fact, what I truly believe is that we're going to get through this stay-at-home order, and I think that coming out of this crisis, auto retail will do exactly what it did out of the Great Recession, which is be the leading industry out of the recession. And part of that is because we are such an important industry to the American economy. We employ 1.1 million people. We're 20% of all retail jobs. And if you include also the auto manufacturers and all the people they employ, it is imperative that the auto industry restart with a vengeance. And we're very sensitive to the credit markets. And what I'm saying is that unlike in the Great Recession, where it took about a year for Congress to get together to get incentives in place and things going to restart the American economy, in this case, TALF was restarted in weeks. And we have trillions of dollars that are out there to support. The Fed is supporting the credit markets and also consumers, and then we have very low interest rates. So I expect, because we are so sensitive to the financial markets and because the financial markets are being so well supported by the government, that we will be a leading beacon of light in this as we get out of this recession. And it's important for everyone to remember that by 2010, the average dealer had increased their earnings to $870,000, while unemployment was still at 10% at that point, and the SAR was only at 12 million. And yet the average dealer was earning 31% return on equity. And that snapshot is exactly why auto retail is such an attractive industry to invest in. So the reason I don't think there's the Asbury Park Place transaction being terminated is a reflection of what we're going to see in the future, is because I actually am finding at our firm that we have more buyer interest than we've had ever. We are having calls. People are calling us to see how they can get into the industry. Private buyers are anxious to grow. So I think you're going to see a tremendous amount of buy-sell activity on the other side of this crisis, and I think we could see consolidation go into superdrive mode, and it could be a very exciting time. I mean, to give you a sense, one of the trends that we talked about in the Blue Sky Report was that more professionally managed capital, so family offices, high net worth individuals, even some private equity, will get into this industry and back successful dealers to grow and create new groups in the private side of the equation. And that is definitely playing out in the number of phone calls and number of discussions we've had since the pandemic started is actually increased by many fold. So we believe that we're going to see a lot of activity coming out of this crisis.
Well, that is certainly optimistic, I would say. How is this whole pandemic impacting blue sky values overall, in your estimation?
So, our view right now on valuation is that we see today's times in which dealerships are not really operational as effectively a one-time adjustment. So we do not believe dealerships are going to be valued based on being closed or not selling cars. We believe the valuations will be, buyers will look to how the dealership performed before the crisis, and I'd like to point out that going into March, our industry's earnings were up 38%, and we were approaching 2015 highs. So we were in a very strong position before the pandemic broke out. So I think that buyers are going to look at earnings before, and then they're going to project earnings going forward. And that, of course, is very difficult to do until we see some indication of how the consumer is going to come out of this on the other side, and also what the government's going to do, which I expect they will do quite a bit. But so for now, I believe that, as I said before, dealers are just not selling. So when situations like this happen, the market just slows. So we estimate that the buy-sell market will decline by 50% in 2020 because there's just going to be no transactions. But that's because valuations are sticky in our industry, and no one's going to drop their valuation. And the buyers will want to get a sense as to where we're going to be on the other side before they jump in. Now, I'll just say one other point on that is that for the top franchises, those that there are very few of, or those that have such strong business models, like a Toyota, where you have, the average Toyota store has 27,000 UIOs in the market, or Honda 21,000. So the most, those two are the highest, followed by Lexus. I mean, those kind of franchises where where the sustainability of the business model is so strong, I think that those valuations and those transactions may occur sooner because those values are just so predictable in terms of just the strength of the service department and the strength of the overall dynamics of how much market share those franchises have. So I think those valuations will be the stickiest of all, and you won't see any decline in the top franchises' values coming out of this pandemic.
Well, that's really helpful, Erin. I know that you mentioned during a previous podcast that you did with me that you guys typically see a 6-month lag time in buy-sell trends. So with that in mind, do you think we're going to need to wait several months before fully assessing the impact of this pandemic on dealerships?
So we did a webinar for dealers on how we think the pandemic is going to affect the buy-sell market, and our overall view is that from as soon as it started until we see a peak in cases, we're not going to see much of any activity. So let's just say that's sometime April, May. As the cases decline, we expect we'll see some distressed transactions as the cases decline, because those are going to be ones that have to get done. And let's say, assuming we're starting to really open up the economy again in the summer, we believe in the summer you're going to start seeing all those transactions that were put on hold, where someone said, okay, let's just put a pin in this transaction because we don't know what's going on now. We think those ones will re-engage, and some will close and some will not, because sometimes buyers are going to want to change in price and seller will not accept. But so we think those ones will be the first ones to start closing, and those ones will already have a running start because they were in the midst of being done when this all broke out. We think you'll see those ones start to close in the summer into fall time frame. At that same time as hopefully the economy starts picking up again, we think that you'll see those sellers that feel strong and confident about their valuation start to come to market in the second half. And the fall will be an active deal-making time. You'll see some closings at the end of 2020, and we think the first quarter and the second quarter of 2021 could be tremendously active in terms of the number of transactions closing.
Well, Erin, you've been incredibly insightful. Just before we wrap up, is there anything that we missed that you want to note for Beltway Talk listeners?
I guess I would just reiterate that auto retail is bigger than the new car department. I think everyone seems to oftentimes focus so much in on where the SAR is going to be, but we were making a lot of money when the SAR was still pretty low coming out of the Great Recession. And so even if the SAR is impacted for some time, I do expect that we are going to be a leaner and more productive industry coming out of this really unforeseen crisis that we are all living through. And I think we are going to be a much more profitable industry coming out of this. And that's actually really a positive, as difficult as all this is, of course. I think that is the one silver lining, that we will be just a much more efficient, productive, and profitable industry as a result of the pain that unfortunately we're all suffering right now.
Well, great. Thank you so much for joining Beltway Talk today, Erin. Your insight is really appreciated, and I think we will look forward to having you on probably again in the next few months, where we can kind of catch up on what's been going on since this podcast.
Okay, Hannah. Well, again, please, everyone on the line, stay safe and healthy, and everyone in our industry is really in our thoughts and prayers during this challenging time.
Thanks again to Erin for joining us on Beltway Talk. And to you listeners, thank you for tuning in. For more coronavirus resources for your business, including AIADA's special COVID-19 webinar series, you can check out aiada.org/coronavirus. Join us again next time for Beltway Talk.